A very good afternoon, everyone. A happy new year from us all here in the AIM investment team. And thank you very much for joining January's edition of the Blackfinch AIM and Focus webinar. Before we start to dig through the thickets of the UK and more specifically the AIM market, I'd like to give a brief overview of the agenda for today. So firstly, I'm going to tackle the final quarter of 2024 and talk more broadly on the direction of travel for the UK and how this may trickle down into the AIM market. And then once we've finished that recap, I'm going to hand over to Lawrence Campin, investment manager for Blackfinch AIM, who's going to touch on what we've been hearing on the ground floor when engaging with AIM companies. And I do think it can quickly be lost when we're staring at charts or market indices all day that these are real businesses that we meet on a regular basis who supply real jobs. So there's no better place to get the news straight from the horse's mouth from Lawrence, who's going to deliver that in just a moment. And finally, I'll pass on to our head of AIM, Chris Swanepoel, who's going to explore the current value in the AIM market and what it may look like over the longer term. Chris has decades of experience, who's traded through some of the most historic bear markets like the GFC, so his insight's going to be really invaluable here. And the goal of today is to arm yourselves with information to take into client meetings to address any challenges or why now might be an attractive entry point considering the value on offer for investors. Some final housekeeping points. What we discuss in this webinar doesn't form investment advice and is purely views from us here in the investment team. Please also note that we're on hand to discuss any of the topics from today. Should you want to submit any questions for us to debate in future webinars, feel free to use that link contained in the sign-up page. But just in case, the email is eventswebinars@blackfinch.com. So before we do a look back at 2024 and into 25, we'd like to reinforce that we're bottom-up, long-term buy and hold investors in Blackfinch AIM, where we want to identify compelling UK businesses for sustainable long-term growth. However, if you've watched our previous webinar, we discussed the level of macroeconomic sensitivity that really has been the driving force for a solid return on investment. So what I'd like to do very quickly is run through the macro events to offer some clarity really on what's going on here in the market. And as Lawrence and Chris will go on to explain, we really do have some exciting and innovative businesses in our portfolios that are trading strongly through these market conditions. Now then, it has been a difficult period for AIM investors and us as investment managers, where we're currently going through one of the longest bear markets in AIM's history. If we look back at 2024 and the UK's economic cycle, it looked as though we began our cyclical recovery in the first half of the year. We saw a spring/summer rally as Bank of England interest rate cuts were priced into the market, and the new Labour government was elected on their pro-growth manifesto and prospects of political stability. But as we move through the third quarter of the year and into the fourth, difficult decisions had to be made regarding public finances that led to a budget that raised taxes on the private sector. Now, this can be considered a short-term fix, but really we need a growing private sector to generate increasing tax receipts rather than a sugar rush of public spending that's been proposed. So the result was that sentiment became more sour. What was once optimism over this pro-growth agenda and political stability turned into uncertainty, and there were reports of businesses cutting back on hiring while raising the prospects of price hikes to pay for these proposed taxes. And in addition to those hikes, government spending is set to rise more than taxes are increasing, and therefore borrowing may have to increase. And therein lies one of the fundamental issues causing some of this more near-term market volatility. The Chancellor's set a fiscal rule to fund all day-to-day spending with tax receipts by the 2029-2030 financial year, and the result of which has left a very slim headroom of about £10 billion. These concerns on funding grounds is what's spooked investors recently, where rising government bond yields have meant that headroom could quickly evaporate due to higher interest expenses. The tricky part is that the government wants to retain fiscal control, which leaves room for tax hikes or cuts to government spending as the only options if yields were to continue to rise. The Treasury's indicated this would come from cuts to government spending, which would in turn be some good relief for the private sector after those tax hikes in the budget. And this is something that we're watching closely within the Blackfinch Group's wider research team. We need to see some form of catalyst to help boost sentiment and spike flows back into the UK market. For the moment, it has very much been a period of US exceptionalism, and this is where we've seen some of the funds going. It's worth noting we have seen some pockets of improving sentiment at times, like the days after the budget where stocks rallied, or much more recently, UK CPI coming under expectations at 2.5%, and that helped improve prospects of a Bank of England interest rate cut. But there are certainly more structural requirements here in order to turn the tide. If we do see up that cut in government spending, for example, then this will be a conscious choice by Labour to learn some of the lessons from Tories to consider UK businesses, and we could see some form of broad-based rally. But for the moment, all eyes are going to be on that spring forecast on the 26th of March and what that may bring, or sooner if bond vigilantes continue to place pressure. But that's one of the main talking points to performance currently. Sentiment is king for the UK, and unfortunately it isn't with us at the moment. But while we wait for that macro tide to turn, it's important that we remain proactive in the portfolios. There are ways for us to mitigate further downside risk and still look to drive alpha. As Lawrence mentioned in our previous webinar, these kinds of bear markets can bring considerable takeover activity, and that's a great way for us to earn an immediate premium on a stock and redeploy the newly freed capital into new ideas. And Chris is going to look to explore that in more detail in just a moment and show what value is really on offer here. And it isn't just us looking to be active in like the current environment. I've heard a lot of noise on the ground from our investee companies on what they're doing to shore up their financial position. And with all of that in mind, Lawrence, I think I'll hand over to you to explore that further.
Thanks, Josh, and good afternoon, everyone. So a continuing trend we have seen over the past few months is companies carrying out restructuring activity. So this has taken various forms, but common activities included combining manufacturing or office footprints, finding efficiencies which can enable the trim in headcounts, and also paying down debts. So this helps protect margins in the current challenging market conditions, but also, in our view, better positions businesses to carry out acquisitions and boost growth looking forwards. So we have also seen continued diversification of manufacturing away from China into other low-cost geographies, which are likely to attract more favorable US tariff terms compared with China. So this is not a new theme and has been ongoing for some years now. A good example of this is with the company called Volek, an integrated manufacturing specialist which manufactures and supplies critical power and data transmission products globally, such as data cables or EV chargers. And Volex is an investee company of the Adapt AIM growth portfolio. So Volex increased its global manufacturing footprint by 15% in the first half of 2024, and they expanded into Indonesia, India, and Mexico. And they have further expansions planned in the second half of the year, including into Turkey. So this expansion outside of China is both driven by immediate customer demand, but also partly ahead of the expected demand from alternative low-cost countries. Finally, a common topic which companies have been addressing is the upcoming increasing employers' national insurance contributions and also the rising minimum wage. So commentary from companies on this has varied. So the very best placed companies with pricing power and strong market positions say they will raise pricing to fully mitigate. A good example of this is Ashted Technology, a global subsea equipment rental and solutions provider to both the oil and gas sector and also the offshore wind sector. And Ashtek Technology is a recent addition to the growth portfolio. So the company put through a 13% price rise in 2023, with strong demand seen for its rental equipment, which is believed to be the largest and most advanced on the market. So management confirmed in a recent investor meeting that they will adjust pricing again this year to ensure the increased costs are fully passed on. So I'll now hand over to Chris to cover the value on offer in the AIM markets and also the outlook.
Thank you very much, Lawrence, and good afternoon all. I will attempt to share a few slides as I talk, always tricky doing it live, so please bear with me if we run into a few technical issues. Now, a clear sign of value in the portfolio are the takeover approaches we've seen in the market and the portfolio, which clearly underscores value that others and particularly private equity houses see in the AIM market. In this regard, let me just share the screen with you. In this regard, we've just had yet another recommended cash offer from DBay for Alliance Pharma, our largest position on the AIM portfolio, our growth portfolio. and also as one of the first announcements of the year. Alliance is a stock we presented as a clear value opportunity and possible target in our presentations in November, along with some of the other stocks in this chart showing the depressed price earnings valuations. Alliance Pharma is being taken out at a healthy 40% premium to the stock price, and this provides us with the natural opportunity to redeploy the proceeds into the very attractive investments we identified in AIM. We benefited from this redeployment of cash in the latest takeover of Echo just before Christmas into two new holdings, Sigma Rock, a leading lime and limestone group targeting quarried materials in UK and Northern Europe, and Ashtec Technology, the subsea equipment rental provider, as Lawrence mentioned. We expect significant upside from these two stocks, who both demonstrate significant growth potential organically, as Lawrence mentioned on Ashtead, and through acquisition, which I will touch on later. Balance sheet strength is also a sign of stored up value in the portfolios. Over half of the companies in the portfolios have net cash on the balance sheet. Some of these have significant cash resources and, importantly, provides opportunities for these companies to take advantage of the low valuations in their acquisition strategies. Only this week, one of our portfolio companies, Gamma Communications, announced a substantial acquisition of Starface in Germany for £165 million. Both our two recent additions, Sigma Rock and Ashtead Technology, are also taking advantage of depressed valuations to make earnings-enhancing acquisitions. As such, we see benefits of takeover and low valuations in the portfolio from two directions, not just as sellers to PE, but also as buyers. The value stored in the portfolio is not only demonstrated by the low PE valuations, as we can see in this chart, across the whole market, but also by the depressed discounted cash flow intrinsic value we calculate on the portfolio. A year ago, we saw upside of circa 40% on our DCFs, and now we calculate at on a conservative basis, close to around 60% upside to our calculated intrinsic value. Additionally, there is substantial yield support on our income portfolios, with a calculated yield of 4.3% in addition to the growth prospects. We recognise it's been a tough time in the UK market, and especially AIM, since August 2021. From our experience and looking at previous rebounds in the market, as we can see in this chart, a clear 120% return post the global financial crisis. And post-COVID, additionally, we had a 30% rebound in AIM. Factor in the clear value in the market, I strongly suggest that you simply can't keep a good thing down, and the market will revert to its true value. We have brilliant British businesses in AIM and the portfolio, which we strongly believe will show their true investment potential in the coming months and years to come. As the saying goes, it is darkest before dawn, and once the negative sentiment reverses, as Josh mentioned, in our view, it is not time to flinch and sell at the bottom, as we sincerely believe that the portfolios are very well placed to rebound, as we've experienced in the past. Thank you all for joining, and with that, I'll hand back to Josh.
Thank you, Chris. Thank you, Lawrence. Some great insights there. Now, that's everything for the January 2025 AIM in Focus webinar. So again, thank you, Chris and Lawrence, for joining us, but more importantly, thank you for tuning in, all of you. I hope you've got some nuggets to take away for your client meetings this week and onward. But as always, should you have any questions off the back of today's content, feel free to contact your dedicated business development manager, and we'll ensure to get back to you. The next webinar is held on the third Thursday of every new quarter, meaning the next is Thursday, the 17th of April at the same time of 1 p.m. We look forward to seeing you there, and bye for now.